Hello and a warm welcome to Talking Stocks. I'm Gugulethu Cele. In studio with me today is Ashton and Hechter, who are both from Anchor Capital. Now that's as we try to get insight into Clicks, a leading South African pharmacy, health and beauty retailer with 500 stores and 390 in-store dispensaries. Gentlemen, good to have you with us today. I can relate to Clicks. I know them very well. I have my club card and I get points like any typical female because of the advancements that they've made with regard to the kind of products that they provide. But talk to us about the size and the scale, firstly, of this particular entity and the different divisions that make up Clicks Group. Sean?
Absolutely. So you've got, as we've already mentioned, it's a leading chain pharmacy business across South Africa, 500 outlets. But importantly, there's a retail component to it and a pharmacy component to it, as well as a distribution chain, which effectively services the pharmacies within each retailer, as well as external pharmacies that they supply to in the broader market. And I think what this business has done particularly well in recent years has been to increasingly add pharmacies in the back of a existing Click store, because if you look at not all of the Click stores have had a pharmacy over time, and what that tends to do is drive traffic into those stores. So it's all about generating front shop sales, and they've been very, very successful in doing that. I think where the juice really sits is not necessarily in the pharmacy side of the business, because that's quite a low margin retail business if you look at the markups that you're allowed to charge, because that's largely regulated for prescription products. But if you've got a pharmacy in your store, you're able to generate far better footfall through each store, and that's been really the story, is that they've been increasingly rolling out pharmacies into the existing chain, and I think there's still runway to go with that.
I take it that's also the magic, or rather the secret sauce that they have, because as you've mentioned, the foot traffic is what they need there. But with regard to distribution, as well as this particular entity, UPD, I understand, how much more market share could they catch up on here?
So I think there's, I'm not sure necessarily that UPD is a market share story necessarily. Naturally, if Clicks itself gains market share within the South African market, and I think there is a trend internationally for retailers to become increasingly corporatized. In other words, you move away from independence as an economy develops towards corporate pharmacy chains. You've seen that with Boots in the UK. You've seen it with Walgreens in the States, and I think that you would expect to see that a continuation of that trend in South Africa. But remember that UPD does not just supply Clicks chains, it supplies a whole lot of independents as well. So yes, you'll see more turnover growth coming through from Click stores into the UPD chain as they continue to roll out new stores. But again, you need to remember that they're supplying a broader market too.
If it does come to the retail segment, if we can come to you here, Liam, Musica. Last I checked, I think this was one of the companies that took slight pressure, given the fact that mobile downloads are all the craze. Not many more people are picking up CDs these days.
Yes, I think Musica is quite small in the mix on the retail side, so not necessarily integral to the thesis on Clicks. I don't think Musica has the ability to sync Clicks or to really make it a huge success. I think management have done pretty well in pivoting the Musica model to sort of just adjust to the changing circumstances. 10, 15 years ago, going into Musica was just about buying a CD, and obviously that's changed, and the models Musica obviously sells a whole bunch of different types of things, all linked to the same sort of genre, so entertainment.
Gaming consoles and the games associated with it. That's a typical product that you can buy there now.
Exactly.
So it's not really a music business per se anymore.
Precisely. On that note, though, if we take a look at some of the metrics and the compound annual growth rate, this is quite substantial, double digits firstly, especially in a market where we always hear about a constrained consumer segment in South Africa. How substantial is this?
Very defensive business model. I think the business model has proven itself, and the continued push to rolling out more pharmacies, I think, has got legs behind it. So they've delivered about 16% compound earnings growth over the last, must be 10 years or so. I would expect that they still have the ability to grow 10 to 15% per annum. But I think the important point to also realize with part of the magic of how they've achieved this is they've been very good at improving the terms that they get with their suppliers and creditors. So you've seen working capital days have compressed as well, which has freed up a lot more cash flow, which has allowed them to manage their equity base down by buying back shares. And if you look at over probably since 2007, I think the share count has dropped by about 30%. So kind of 3% plus per annum on average in terms of reduction of shares in issue. and that's been earnings accretive. So a large part of the earnings growth, or certainly a meaningful part of the earnings growth story, is coming through managing the capital base. Now, part of the risk in that is that at a much higher valuation, and as we'll talk about, the valuation has become increasingly stretched. You can't engineer earnings growth as easily with buybacks as you used to be able to do.
On that note, let's perhaps take a look at the valuation, looking very stretched at the moment, but also looks as though it's in line with its retail counterparts, many of which do have PEs in the region of 20 plus?
So I think on a forward basis, it's a significant premium. We wouldn't say that it's in line necessarily. It's trading at more than one standard deviation, probably close to two, over two standard deviations above its long-term kind of 10-year average. It used to trade at a mid-teen forward multiple. I think the cost of money globally obviously has come down. So there may be an argument that the whole market has been justified in seeing a re-rating because equities offer yield. But we would be arguing now at a forward 25 times multiple, you're pricing in more growth than we think they will deliver on a long-term basis.
On the chart regarding the HEPS history, though, it has been a significant consistent performer, as you have highlighted. But again, coming back to the macroeconomic themes, Liam, could this be under pressure slightly?
I think Clicks' ability to continue growing in that sort of mid-teen range. So I think that you'd probably see 15% growth out of them this year, and then probably staying above 12 to 13% growth for at least the next 2 or 3 years. They've got the ability to add pharmacies to the store base. So they at the moment have 500 Clicks stores, about 390 odd pharmacies. We sort of see that moving towards a 600 store mark, and them to continue adding pharmacies to that. They recently signed a deal with they're in the process of concluding a deal with Netcare, where Netcare are outsourcing their pharmacies to Clicks. So there's about 80 odd, maybe more than 80 pharmacies that they would add to their pharmacy base, which sort of feeds into a vertically integrated model for them. So in terms of their ability to keep growing, I don't think that you'll see it, unless there's a huge consumer slowdown, which is possible. But I think in the current environment, they could probably sustain at least above 10% growth in EPS. I think our concern is more, is that enough with the current share price and the current rating on the share? So I think if you look over time, its return on capital employed, as Sean has mentioned, governed by how management have allocated capital. I think they've done a fantastic job, and you've seen this sort of ramp up in the return on capital employed, and I think that has pushed sort of the rating of the stock up. I think the defensiveness of the cash flows of the stock have also added to the premium that it trades at. However, I think that at the moment that premium is a little bit too high. I think we look on the stock at on a price to earnings basis for simplicity, but also on an EV to EBITDA basis, and on both metrics it's trading at an incredibly high multiple.
From a competitive landscape perspective, Shoprite also introduced pharmacies within some of its local stores, Checkers as well as Shoprite, I think through MediRite. Does this also pose a significant amount of competition to the likes of Clicks, not to mention the unlisted Dis-Chem holdings too?
Look, I think it is new competition naturally, but I think Clicks is the leader in this space, and I wouldn't expect that something like Shoprite is going to unseat their model. And I think a large part of it is also around the club card benefits that you mentioned. So
loyalty,
you had quite a loyal user base there, which is not necessarily just going to up and go to utilize a different pharmacy. In addition, you might have repeat customers where your prescription is kind of with a particular pharmacist. It's a pain to actually change that. So I think you do have quite an engaged user base once you've got customers in your door. So I'd say that that's quite sticky.
Just before we do get to buy, hold, sell, and not to gauge your views as to whether you're buying or holding or selling the stock, but essentially if you're buying Clicks, you're not necessarily buying it for the retail value, despite the fact that that's the most significant contributor to revenue, right? Would you buying it more for the pharmaceutical base?
So I think you're buying it for the retail value, but a lot of the retail value is going to come through as a result of getting people into the stores with a strategy of opening up more pharmacies in the existing stores, because as we've seen, not all of them have a pharmacy, but B, new stores that they open. And we could expect that every new store that they open would have a pharmacy in it. So integral to the strategy of improving sales densities in the retail stores would be to have that pharmacy at the back where you have to walk through the front shop to go and get your prescription.
With that being said, let's get our experts' views now whether to buy, hold or sell Clicks holdings. Liam, let's start off with you. Or would you buy or hold or sell Clicks?
I think it's a great business, but at this valuation, I would certainly sell it. The thesis behind that is I think that there are some headwinds to this business that the market's possibly not pricing in. I think, as mentioned before, it's got the ability to sustain its earnings. I think it should be able to defend it. However, there are downside risks to that. I don't see a multinational coming in competing with them in South Africa. However, Dis-Chem is a formidable competitor and will continue to be. I think that at the moment the valuation is just looking a little bit too full for me.
Sean?
So I'm going to be boring and largely echo that view. And it's important to state that at the outset that you've got to distinguish between a good business and a good share. And I think the first point to make here is management has done a fantastic job in this company. The return on equity is 53%. It is a very, very good business. But I'm saying I think it's overvalued. And as a result, for me, there's a valuation problem. And I think your upside risk versus downside risk here is skewed. Not being compensated in dividend yield. It's probably about a 2.5% dividend yield. Yes, they'll deliver the growth, we think, in a fairly metronomic manner in terms of earnings growth. But it's not high enough to justify this rating.
To close off with, are we fairly confident in the management that they have in place at the moment?
Absolutely.
Yeah, I think they've done a great job and will continue to sort of on the same path that they have up until now.
We'll leave it there for today. Thank you so much for your time today, gentlemen, and giving us your views on Clicks Group overall. But a big thank you once more to Sean Ashton, together with Liam Hechter, both from Anchor Capital. Do be sure to join us again next time where we talk more stocks.